Ladies and gentlemen, dear colleagues, welcome back to our conference. We are now entering the third session with regard to capital markets. I'm very grateful to Christos because he explained this morning how it came to the fact that we are having a general title, Banking Union at 10, and now we are speaking on capital markets, which is not very logical. But the interesting link is the year 2014, because this year was not only very important for the banking sector, but also for capital markets, because we got three major European legislative acts in that year. The first one was the Market Abuse Regulation and the accompanying directive on criminal sanctions. The second was the Markets in Financial Instruments Regulation, MiFIR, and the correspondent directive, MiFID II. And the third was the Regulation on Packaged Retail Investment and Insurance Products, in short, PRIPS. And the three are the main focus we have today. So we first will look at PRIPS and then on MiFID, and later on we will take a closer look on the developments in market abuse regulation. If we look at these three legislative acts, they represent a fundamental change in certain respects. The first, the Market Abuse Regulation, represents the change from minimum harmonization executed by directives to a new system where we have a full harmonization by a regulation and an accompanying directive. So additional regulation in the directive. And there's a second striking feature with that regulation, and that's the fact that we have criminal sanctions on the European level. Article 83, subparagraph 2 of the Treaty of the Functioning of the European Union allows directives on criminal sanctions only if a harmonization proves to be essential to ensure the effective implementation of a union policy in an area which has been subject to harmonization measures. As far as I can see, this was the first time ever that this provision in the treaty was applied in the field of financial regulations. And we talk a lot about enforcement. We are talking about enforcement through civil proceedings, and here we have an example for enforcement through criminal proceedings on the European level. My second remark refers to MiFIR. It brought about a major change, a major breakthrough in harmonization of the third country regime. It is the first regulation which has a uniform approach to third country financial services providers. And of course, a major impact on the concept of equivalence. MiFID II and the Level 2 Acts broadened the maximum harmonization with regard to the rules of conduct, which in the end helped to grant a level playing field in the European Union with regard to financial services. And finally, PRIPS is remarkable because it changed the concept of disclosure and for the first time addressed the problem of information overload. Today we are glad and honored to have four experts on those topics who will give us a short review on these legislative acts and at their impact at the time they were enacted. And additionally, we will analyze whether these acts are still future-proof. As we all know, MAR and MiFID II have got a sister legal act now called MiCA, which will we address as well. So my first speaker I would like to introduce is Stefan Pankoke. He holds a PhD in law, and he studied not only law, but also has also obtained a degree in computer science, which I think is very remarkable. And he has worked as the Max Planck Institute for Private and Private International Law in Hamburg, and then joined the German Supervisory Authority BaFin, and later on in 2017, the Swiss Financial Market Supervisory Authority, FINMA. So in sum, he has 20 years of experience in supervisory law, and he is very much interested in capital markets, in particular market transparency and prospective liability. And he will speak to us on PRIPS regulation, background, current reform, and open questions. Our second speaker is Professor Matteo Gargantini. He holds a degree and a PhD in law and economics on banking and financial market law from the University of Vienna. And he also worked for a supervisory authority, the Italian one, Counsel, and he has 8 years of experience working in the supervisory field. He became assistant professor of European economic law at the University of Utrecht and changed now to the University of Geneva last year, where he holds an assistant professorship with tenure track. And additionally, he is adjunct professor of financial institutions and markets law at Bocconi University. His main fields of research are capital markets, banking, and company law. And he will speak about MiFID II and the Capital Market Union. Are we there yet? Our third speaker is Professor Iris Barsan. She studied law in Germany and studied German and French law in Cologne and at the Sorbonne, and holds a master in business and economic law. She has a lot of banking experience, 6 years of working for a big bank in France. She has a doctorate in law, passed the bar exam in 2015, and since 2016 she is a lawyer in the field of compliance for data protection and banking and financial regulation, and since 2014 she is assistant professor at the University UPEC in Paris. She will speak about market abuse under MiCA. Our fourth speaker is Professor Matthias Lehmann. He started his career in Germany, studied at the University of Vienna and got his PhD from that university in 2002. He then changed to Columbia University in New York, where he obtained an LLM, came back to Germany for the habilitation and for his first chair at the Martin Luther University in Halle-Wittenberg. Later on, he changed to the University of Bonn, and since 2020, he is professor at the University of Vienna. And since 2022, he is also professor for European and Comparative Business Law at the Radboud University in Nijmegen, Netherlands. He is interested in cross-border financial market regulation, international private law, comparative economic law, and he will speak about dreaming about MiCA. Thank you very much. Thank you very much, Stefan. You gave us a very detailed and critical analysis of the regulation, and you evaluated the upcoming reform. I was personally very interested in your experience with a kid, so I share your view. It's not always helpful to read the instrument because sometimes you're less informed afterwards than before. So we hope all for improvement. Our next speaker, Matteo, will help us about MiFID II and upcoming improvements. So we're very keen on your speech. The floor is yours, Matteo.
Well, thank you very much, and thank you to the European Banking Institute for the invitation. I'm just waiting for my slides to come. Well, perfect. So I would like to share with you today some ideas and some reflections on the role of MiFID II, encompassing both the directive and the regulation MiFIR and their role in the Capital Markets Union, and along with the thread that we have been asked to work on, to look a little bit to the past, to see what we achieved, and then into the future. Of course, that's a daunting task for only 25 minutes, so I will try to be as short as I can, but I essentially will focus on some examples I think there can be of help to understand a little bit the broad scheme. So my first question would be, well, again, this has already been pointed out, why are we talking about a capital markets union in a conference that is dedicated essentially to the European Banking Union? And beside the 2014 as a starting data, maybe I will work a little bit on that, but very shortly, just to highlight what the line of reasoning will be for the other 2 points that you see here. So why harmonization is important, then I will give some examples how that's working or not working in the investment services, and in the trading industry. So we'll also try to talk a little bit about MiFIR. And finally, my final point would be that, while it's excellent to work on regulation, we have a lot of regulatory fatigue around MiFID II and MiFIR that have been changing so much over time. But maybe it's time to start thinking a bit more about enforcement and maybe a little bit less about regulation. So I will add more on that later. So why are we talking about the Capital Markets Union in a conference dedicated to the European Banking Union? So what's the connection between these two ambitious projects? Well, they are a little bit in an awkward connection. I mean, to some extent, they are competing with each other. You can actually rely on capital markets, think about bond markets when you have a credit crunch that can affect the let's say, traditional, especially in the European Union, traditional way to fund firms. But to another extent, they are also working along with each other, meaning that a good capital markets union can be a good supporting element for a resilient banking union. That's not just because facilitating, for instance, equity investment can make well, firms in general more resilient to the benefit of banks that are lending money to the same firms, but also, and this is what I will follow up on in my presentation, in a system where we have, at least in the single currency area, in a system where we have a single currency, but we have some issues with the cross-border movements of some input factors such as workers or, well, public budgets. Now, having integrated capital markets is very important to make the whole system more stable, because we should be really wary of asymmetric shocks. And the more you diversify your portfolio as an investor, the more you make the whole system more stable, because you will be less subject to the shocks that are occurring in your home country alone. So this makes sense, in my opinion. At least it justifies asking ourselves, are we on the right path when it comes to the legal integration? So the idea that firms and investors should be able to operate ideally on a cross-border basis, just like they do on a purely national one. So that's the question I'm going to address in the remainder of my presentation, and it's really more about the legal integration. So are we there yet? That's a question that could be asked, of course, about the entire Capital Markets Union, but again, I will be focusing only on the MiFID II and the MiFIR. I will refer again to them collectively as MiFID II. But I think answering a question like that one is would really require a cross-sectoral analysis. So I will essentially focus on the enhanced harmonization that we need to foster capital markets integration. And then I will try to delve into a couple of examples taken really just because I think they are helpful to show a little bit how, what's going on. They might be not the best examples ever, but this is how I feel one could see the big pictures looking at the details. And those two points are the investment services, so the retail investor protection in particular, and again, the organization of the trading industry. So that's more of a MiFIR topic. Well, of course, the answer to my initial question, are we there yet, is, well, of course, not yet. But I think one shouldn't really be too, let's say, negative about that. Well, we are, most of us are academics. We're always kind of fighting to cope with the deadlines. And I always complain to my colleagues, well, I will never make it if I look at the future. And for instance, McKenzie here, he always tells me, well, but you should look at the past. Look what you did last year. Well, that really helps, I have to say, getting into a better mood. And I think that's the case also with the Capital Markets Union. So a lot of good things were done, actually, in the Capital Markets Union, if you look. Well, the Capital Markets Union is of 2015, but let's start from the 2014 key date, which is a little bit the connecting element of the entire conference. So, well, a lot of views of delegated and implementing measures that's essentially, sorry, there is an issue with the layout, as you can see, so I have a picture that in this case is covering part of my text. But so we are getting essentially to creating a single rule book also in the capital markets world, sort of a twin compared to the one that characterizes the banking union. There is also, in my opinion, quite a good combination for a legal system that plans to become complete. A good combination between standards, which gives a bit of flexibility to the system, and rules that actually are supposed to lead to more legal certainty, especially in the field of investment services. When it comes to the market structure, where again, if you compare the situation with the MiFID I, a lot of improvements there too. So we essentially, well, now we have this share trading obligation that is sort of facilitating a little bit the creation of liquidity, even in a fragmented market system. A lot of transparency actually on the non-equity markets, maybe too much. So now we are trying to go back. We realize that shedding too much sunlight on the bond markets might not be a very good idea, especially if, as is very often the case, if you have trading systems that are basically voice trading or request for quote systems that would basically kill the market. That's why the Commission is now planning to go back a bit on that. We have also a governance for the market data, which I think will be a very important topic for the future. And there are also quite some good results. I believe, I have to confess, I was very skeptical at the very beginning on the very idea of the SMEs growth markets. I thought that they would essentially signal some weakness, but they are really working apparently. And we have some success stories like Sweden. I mean, they have a thriving financial market that is, well, of course, working with the same rules. So this shows, in my opinion, well, maybe one shouldn't really overemphasize that, but it shows that you can make it even under these rules here. So is and everything already achieved? And of course not. That's the obvious answer. So let's again go back to my example on the investment services. If you look at the innovations again in MiFID II, a lot of things there. Well, a refined suitability and appropriateness test. The independent advice was introduced back then, along with the rules on inducements and the product governance. I'm also a big fan of that. I think it's a very effective way to protect investors. Not all of them delivered, of course. So, for instance, independent advice appears to be a little bit too expensive again. But these are things that the Commission is working on with the retail investment strategy. Not quite sure how far all of the provisions in there will go, but still, that's a very good attempt to refine a little bit. For instance, the appropriateness test will be including also an assessment of the capacity to bear losses as opposed to what happens today. So it will be broadened up a bit. The idea is also to make independent advice cheaper, to reduce the advice gap for good quality advice, to allow independent advisors to only refer to a subset of simple financial instruments. But again, a lot of uncertainties still to be tackled there. Some of them are connected to the new field of sustainable finance. There is an entire panel tomorrow on that, so I'm not saying too much. The only thing I would like to mention, if you try to read how the ESG preferences of clients should be understood, that's really daunting for somebody that is in the field. I can barely imagine how a client could, even if guided by the intermediary, could cope with that kind of very, very detailed classification. And that's not even talking too much. That's not even very much in line with the taxonomy or the SFDR system. So that's, in my opinion, something to look at in the future, but again, not for today. Something that I would like to highlight a little bit more instead is the fact that we are still subject to a lot of national interpretations on key matters. There are national courts taking very different stances on the MiFID II connected topics. So, for instance, in Italy, for instance, courts are very much keen on checking the rationality of contracts, and they ask things that would not be asked anywhere else. But that's not the only case. Or again, think about the saga with the payment for order flow. Now, the Commission has proposed to ban it, and on this we have a political agreement. It will be enforceable as of 2026 in countries such as, for instance, Germany, where this was allowed. That was not allowed in the Netherlands, of course. Well, the fact that we now have a ban, that will solve at least the misalignment between different countries. But the problem is that the fact that we have so much different interpretations on that kind of topic shows that underlying that we have still national interpretations of conflicts of interest on inducements, and especially on the ability of inducement to enhance the quality of the service, and also on the back execution, which I consider as a key element for the capital markets union. Now, these kind of differences would not be wiped out just because we are banning the payment for order flow. They are there, and they will stay there. So they are a symptom, in my opinion, of a bigger problem. A lot of fragmentation also when it comes to the market structure. We still have 27 national stock exchanges. Here I would refer you to the excellent study by the ECMI SEPs on the situation in the Capital Markets Union. They run a lot of analysis on the economic situation when it comes to the fragmentation of the market structure. So we still have 27 national stock exchanges, so they are not really consolidated. They are only consolidated at the level of the market operator. So we have, for instance, the Euronext network, just to mention one example. But the markets remain national. And to some extent, this also leads to a fragmentation. Well, first on the primary market, meaning that there is not too much, it's not yet that easy as it should be for issuers to tap foreign capital markets and for investors to tap foreign capital markets. So it's a matter for both the supply and the demand side. In my opinion, this goes way beyond MiFID, actually. Where MiFID and actually MiFIR is more pertinent is instead on secondary market, I think. Well, large traders, large dealers are able to have a sort of a consolidated pre-trade information, which helps them do their job. But unfortunately, that's not the case for smaller investors because the sources are really too, they're really still lacking homogeneity from the point of view of the kind of data that are shared. They are format actually the, let's say, pricing policy too. So it's very difficult to consolidate this kind of data. So here is also where the Commission is now planning to intervene. And again, I think there is already quite some political agreement on that. So let's see whether we will have a national market system as they have in the United States. By the moment, we don't have it. It might be good to have something like that. Again, not just for the large investors, but also for the retail ones. Because this is something that I really consider of the utmost importance, even if it's often overlooked. You don't really see what benefit you have if the spread is just a bit narrower, because on the single transaction it's just almost negligible. But if you calculate the, let's say, aggregate value, that's billions that are gained in terms of efficiency. So that's something that I really hope will deliver on the expectations, but still the fragmentation is pretty high out there. So what should we do about that? Again, sorry for the layout. Apparently the PowerPoint is not really working very well. Well, here, just very briefly on a question that is sometimes raised when it comes to talking about the integration of capital markets in the European Union, is the question sounds like, okay, shouldn't we still have capital markets before integrating them? And the question refers to the fact that capital markets are not really equally developed yet in all the member states. So some opinions are saying, well, maybe we should first let them develop, especially where they are not, and then we can think about a union. So what comes first, the capital markets or the union? Which is a little bit of a chicken and egg problem, hence the picture here. I have to say on this point, I would say that in the light of the history of the economic development of countries such as Italy, who are sort of late joiners when it comes to the economic development, where in my country, it was, in the last century, it was actually the foreign capitals that boosted the initial growth, as opposed to the protectionist measures. So I would say we should really first, let's say, keep on focusing on the union. Also because what is missing is the critical mass in the investors, if you compare the size of the investors acting in Europe to that of the United States. That's really something that is telling. I would say working more on legal integration is the right way in any case. But as I said at the beginning, well, one should also be realistic to some extent, I think. So maybe some differences in the national systems are there to stay with us for quite a while. It might be good to try to have something more homogeneous also on the civil law matters, but that's a bit difficult to do. And maybe still accommodating for some differences might be important. What we should look at more in detail, I think, is the enforcement. So we have these differences that are there to stay to some extent. So how do we manage that? How do we manage those? And here I think there is quite some room for improvement. I'm just mentioning two examples. They are not really new, but I think they are not enough under the spotlight when it comes to the public debate. So one has to do again with the conflicting interpretations. Well, just to limit myself to the MiFID II, if I am providing investment services on a cross-border basis towards retail investors in another country, as long as those retail investors will qualify as consumers, the two unfortunately do not coincide, but let's assume that that's the case, then I will be subject to the supervision by my home country authority, but the applicable law and the jurisdiction will be those of the country of destination. So that opens up to a legal risk of conflicting interpretations. Again, I feel a little bit uncomfortable venturing into this kind of things because we have Professor Lehmann here. That's like more his topic. And MiFID is just a very small example. As I said, one should look at the entire picture. So again, where do economic losses occur? That's the title of the article that by Professor Lehmann, who sort of started a bit this kind of analysis, at least at the European level. And well, that question is not really answered yet. Correct me if I am wrong. So again, I'm not really able to give any answers here, but I don't think this question is asked sufficiently often when it comes to the debate. I think working a little bit more not only of the positive integration, so the harmonization in a traditional way, but in the negative one, so on conflicts of law rules would really help. Maybe, again, as it was already suggested, we need a special tool for conflict of law rules when it comes to the financial markets. And the second point is how can we foster even more supervisory convergence? Honestly, I think ESMA is doing a great job there, but as the case of the payment for order flow shows, it might not be enough, not because it's their fault. Maybe they don't have enough powers here. I'm just listing in this slide some examples, but no need to go through all of them. But I think the final question, this is really my last slide. Since we are talking about the capital markets union in connection with the banking union, should we then take inspiration from the banking union and think about a single supervisor? Well, of course, that would, in many regards, wipe out all the different and diverging interpretations we have, at least at the supervisory level. I have to confess I am not so sure about that. Well, not just because I don't think it's feasible. We had some quite quite some attempts in the past that failed. So, for instance, giving ESMA the supervision on the alternative investment fund that are labeled with this EU labels, the EUVECA, EUSFIL. Sorry, the EUVECA LTIF. That could have been done, but it was rejected. And even in the approval of some prospectuses, so for instance, for some special companies like mining companies, and most importantly for third country companies, that was something that was unable to be agreed upon at the political level. So I don't think it's really feasible. But I have to say that, again, if we play more carefully maybe with the conflict of law rules, we might try to foster some level of integration where we might have some multiple single authorities, just like Luxembourg could be already to some extent considered the single authority for UCITS funds, or the Ireland for the hedge funds. Maybe we can use this kind of tools for an intermediate step before we reach maybe a higher level of centralization. Again, I just have questions here. I see they might not meet the approval by everybody, but I think it's worth considering whether we can reach this kind of integration before we can think something that is politically viable. Okay, that was it from my side. Thank you very much for your attention.
Thank you very much, Matteo. You have presented a thorough analysis, what has been achieved, what is still missing. And I was very glad that you mentioned the payment for order flow, because I think it's a level playing field problem. So we should address that as well. And I was glad you mentioned enforcement, because I think that's a major problem. We should address it with MiFID III. So we're now entering into the discussion. Are there any questions from the audience? Filippo, yeah.
Thank you very much. First, I have a general question, maybe for Stefan. We're moving from a capital markets union to a retail investment strategy. It seems that the focus now is on the RIS. And what is your intake on the very complex, I don't want to say monstrous, omnibus directive that touches upon the issues of disclosure a lot? My view is that the directive seems to add further layers of disclosure, assuming that we need more disclosure. My personal view is that we need to simplify the disclosure regime in capital markets because there is an excess of information. On the other side, for Matteo, great presentation, but at the same time, I think that, if you want to make a very good cake, you need good ingredients in your kitchen. And we are at a point where I'm afraid that we lack proper ingredients because we are building this Gothic cathedral of capital markets regulation. Gothic cathedrals are complex. They have all sorts of statues and complexities like the Capital Markets Union. Our ingredients are not really the best. Let me make 4 or 5 very simple examples. First, we do not really know what is a financial instrument. If you want cake, you need flour. If you want to build capital markets, you use the key notion, which is financial instruments. But what is a financial instrument? We do not really know what is an investment fund because the AFMD gives us a negative definition by saying a fund is not what a UCITS is. Okay, but what is a fund? MiCAR, well, again, a great example of a negative definition when MiCAR says, I regulate what is not already regulated. But if we don't know what is already regulated, we don't really know what MiCAR is going to regulate. Trading venues, you were very careful in citing 27 regulated markets. but we have more than 400 trading venues in the EU because we have to consider MTFs, growth markets, OTFs, 435. And we are lucky that we don't have the UK anymore because otherwise there would be more than 600 trading venues. And then private law issues. I fully agree with you. How can we build a capital markets union when enforcement and private law is so dishomogeneous? So I think that you did a great job in reassuring us that we are moving in the right direction. The details are right sometimes. What we see is happening. Principles such as suitability, best execution. Nobody is discussing that, but maybe we are at a turning point where we really have to think whether we have the right ingredients to prepare the right cake. And the ingredients are the fundamental notions of European capital markets legislation, which are unfortunately too much unclear. So I would like to hear your opinion on that.
Yeah, thank you very much. So as you can imagine, I broadly agree with your assessment that more disclosure is not necessarily the solution. I think the Omnibus Directive has a couple of good ideas and solves a couple of individual problems with regards to conflicts of interest, but and also it might remedy some inconsistencies. This being said, and I could redo my presentation on PRIPS replacing a kit with more, disclosure and I think you cannot change an investment culture across Europe because there is no single investment culture. What became clear to me when I looked at these consumer testing studies and other documents relating to PRIPS is that both the investment culture, i.e. the attitude of retail investors towards investments, their risk appetite differs fundamentally among countries. Belgium, for example, has for long been a great structured debt country. So you'll find a lot of certificates in Belgium. And other countries are more, provide incentives through very diverse mechanisms for consumers to be invested in stocks through pension products, and on and on and on. So I think this one-size-fits-all approach, sorry for that, across Europe, it may well conflict with very different traditions in investing. And it's difficult. I mean, when we talk about the capital market union and a single, efficient capital market across Europe, we have to make sure that we do not do harm to or pretend that in all the European countries the conditions for this are the same, the social and cultural conditions, and some of the fragmentations may just be a reflection of investors and their advisors' home bias. I could go on, but I'll stop here.
Okay, well, thank you very much, Filippo, for the comment. Yeah, well, I definitely see your point. Again, the question is how much of the matters you are pointing out, which I agree with, are a matter of interpretation and how much are a matter of regulation. I don't really think we will ever get to a point where regulation could be so specific that will answer all our questions. So, for instance, well, now we're seeing a couple of weeks ago the ESMA document on the notion of financial instrument when it comes to DLT-based. But even in other fields, I mean, what can be covered by the crowdfunding regulation is not clear. In some countries, loans are included, in some others they are not, or same thing for shares into partnerships. I think one way or another we will always have those kind of questions, and we will have to ask ourselves who is better suited to answer them. So that That was just my point. Well, and when it comes to the fragmentation of the market, yes, maybe we have too many trading venues, so they are really small there. And the bet, again, I have no clue whether it will be a successful one or not, is that it's something close to some scholars call the implicit mergers among trading venues, meaning even if you don't have an actual merger, the order book will be only one. So for you, as an investor, it would be the same. You just have one additional column in your table telling you, if you care, where the order is going. But that's a different thing. So I don't see fragmentation as such as a problem. It becomes a problem as it is the case. Admittedly, today we're not able to handle it. Thank you.
Dirk?
So, Dirk Sethe, University of Luxembourg, let me be a bit ironic. We would really take the best interest principle seriously, then we would probably hardly sell any other product than fully diversified ETFs to retail investors. Yeah? So the whole idea of retail investment advice is a bit odd. It's basically labeling something as best interest, which is in fact not the best interest of the investor. And because from a financial perspective, very few investors are so diversified that they need any kind of specialist investment product. Second, what I like about this discussion between local markets and union is, of course, thinking about it conceptually. But for me, market efficiency can well be taking place on the local level. What we should be concerned about is bundling liquidity. The point is not so much whether we have local or regional or global markets. The question is whether we have sufficient liquidity. And if we build this liquidity sufficiently effective inside the European Union, there can be small market segment, let's say, for Polish shares in Warsaw and for other shares in France. As soon as the liquidity is bundled, I'm not concerned how the market is organized. Of course, there's some efficiency generation on the market operator level that presses for scale. So a market operator who has just 20 products will probably not be viable, economically speaking. Yeah? So the transaction cost will be too heavy. But other than that, I'm not concerned of having local market segments for local products. I'm thinking that this is much more about liquidity bridges. And this is maybe my political proposal, that we think better about liquidity bridges from one market segment to the others. To my extent, everything that I know about is so far that we think that best execution should lead to this type of bundling of liquidity over time. But maybe we need there a bit more digital help. You know, quite simple, that, for instance, every market operator must have a kind of transaction interface which automatically executes in a kind of neutral way rather than granting the choice to whoever then discloses a lot of things why it's best execution and eventually it's not. Thank you.
Would you like to comment on the comment? Or?
Should I? Maybe quickly. Well, thank you. Really. Well, I definitely agree with you. Well, actually, if you think about robo-advice, at least up to some years ago, I have to confess I'm not very up to date on that, but many investors were complaining that all the robo-advisors were telling them to invest into ETFs. But maybe that was exactly the right thing to do so. I also entirely agree with you on the liquidity, and what you're saying rings me a bell again with the US system, where they have this order protection system that manages the invest execution in a very different way. Maybe that's a bit more in the direction you are suggesting. Only that.
Any further questions? Then we move on to the topic of MiCA, and Iris, the floor is yours.
Thank you so much, and thank you for the invitation. So the initial question you raised is, do we have our space at a European banking conference to talk about capital markets and crypto markets? Well, the way I see it, banks are not just banks. Banks are financial conglomerates, major actors of capital markets, which is a source of risk that can lead to resolution, obviously. And if we're talking about crypto assets, we just heard banks need to be profitable, well, depending on how interest rates are set, a profitability source can be crypto assets. With the licensing of Bitcoin spot ETFs by the SEC, I think it may become even a more regular source, perhaps. Who knows? And as for MiCAR, well, in my opinion, banks will be the major actors of stablecoins because they are the only ones that can actually deal with the overload of regulation. So this being said, I'm going to talk to you about, or try to talk, so I'm putting myself out here, and I really invite the discussion, especially if you disagree with what I'm going to say, about market abuse under MiCAR. So market, well, where there is a market, there is obviously also always space for abuse, right? For integrity questions, for manipulation, insiders, and so on and so forth. So any market can be manipulated, and the integrity of the market is always a key question. So I don't think I need to stress this. Now, with regards to crypto markets, there is probably a specificity because, roughly said, the crypto markets are slightly different from regular capital markets. They're open 24/7. They never stop. They're extremely volatile. There is specific knowledge that is needed that is not just financial, that is also technological, and some have better knowledge than others. There are instruments like perpetual futures that can be used perpetually to speculate. And there is a huge involvement of automated processes like smart contracts and DAOs, which obviously can increase market tendencies. So this is, in my view at least, a little bit the specificity of crypto markets. Now, if we talk about from MAR to MiCAR, MiCAR is directly a copy of MAR, so to speak, with very little specificities, and this is probably the problem. The main provisions of MAR have been transposed to MiCAR. What has not been, and it is actually a little bit ironic, when you read, for example, recital 95 of MiCAR, where the European Union says, well, issuers of crypto assets and service providers are often SMEs, it would be disproportionate, I quote, to apply the provisions of MAR to them. Well, so they say we need specific rules. Actually, what they did is they applied the main provisions of MAR. What they did not extend to MiCAR is the exemptions. So MiCAR may have, at worst, a harsher effect, or may just be interpreted, if we can do so, in the light of MAR, right? So I'm going to try to talk about a couple of issues I identified. So first of all, the scope, then market manipulation. I'm going to be very quick on that, insider dealing, and what is missing. So to start with the scope first. My first observation will be that NFTs are out of scope of MiCAR. And it is a little bit, well, not surprising, but at least it is ironic because the only two insider dealing cases you actually have on crypto assets that we've identified, one that hasn't been sanctioned because it happened in the European Union. As we just heard, financial instruments are not defined and we do not capture crypto assets under MiFID or MAR for that matter. Is the Sorare Ajax Amsterdam case in 2022. Sorare is a French licorne that is creating these football player collector cards, and then you can also bet on the games of that week. And it happens that the players of Ajax Amsterdam knew that their goalie would be replaced. So they bought the cards of the replacement goalie, betted on him, and made quite some money, which obviously the market didn't know. So classic insider dealing. But NFTs are out of scope, obviously. And the other case is an OpenSea insider dealing case, where very classically an employee of OpenSea knew that some NFTs were going to be listed on OpenSea, so he speculated on them and actually got sanctioned by the SEC last year. So first question is, what is fungibility? And here, actually, a lot of people, well, you know, as the term ICO has been coined in opposition to IPO, to say it's different, but, well, it's not so much different. The term NFT has been coined in order to say, you know, all that regulation you want to apply now to crypto should not apply to us because we're something else. But what does this something else mean? I mean, fungibility in law has a specific meaning. And a lot of things that are so-called non-fungible are actually perfectly fungible from a legal point of view. So here, recital 10 of MiCAR makes some sense because it states, roughly speaking, that fractional parts of one NFT, you can split NFTs into several parts, and several owners can own a fraction. Well, fractional parts are fungible amongst themselves. Large series or collections are obviously fungible. So even if I have just 2 bottles of Cheval Blanc, they're fungible amongst themselves, you know, so if it's the same year, obviously. But anyway, so large series or collectibles, we just don't know what that means. When is something a large series or a collectible? Because in Ferrara's case, if you have just 5 cards on Mbappé, they are fungible amongst themselves, aren't they? So, and the unique identifiers, a lot of people said always, oh, but you know, they're not fungible because the token itself has a number. Well, every bank bill has a number and it still is fungible. So this is not a criteria of fungibility. And so obviously the assets and underlying rights should be non-fungible. But now imagine the NFT, you create 100 NFTs pointing off-chain to the same digital image. Is that fungibility? I mean, the image can be copied, cannot be copied, depending on IP rights, but I have 100 NFTs, each with a number pointing to one image, right? That is off-chain, that I can access. This is not necessarily caught in this definition of fungibility, but just, so I'm finishing here. We could go on and on NFTs, I think, but it's probably a different topic. Now, with regards to the scope of MiCAR, so MAR and MiCAR only apply to assets and financial, so crypto assets and financial instruments, if they are admitted to trading. And once they are admitted to trading, anything is caught. It's caught whether it's on the market, off the market, post-admission or not, anything is caught. The problem I see with MiCAR is non-EU trading platforms. So when does actually a trading platform need to be listed or authorized in the EU? And I see different issues with derivatives, where we have an intersection actually with MiFID also. Now, first of all, MiCAR does not provide for any territorial scope. MiCAR simply does not say when does something happen in the European Union. So obviously a law is supposed to be territorial in application. But we should say, especially in an environment that it has no borders, that is completely technological, that is ubiquitous, when it is deemed happening in the European Union. And so here, when does actually a platform, a trading platform, need to be registered under MiCAR? Do we use the criteria of focalization? Perhaps Matthias can help out here. I mean, we already developed that for litigation on the internet, right? So when you focalize or target a specific territory and your activity is oriented towards this territory, then it's deemed happening in the EU. Well, perhaps, but most crypto trading platforms, the big ones, are all outside the EU. They're not specifically targeting the EU, but still EU investors can, well, trade on these platforms, they can commit market abuse, and they can be victims of market abuse. So are we going to catch everyone just because they exist, and most of the time the language is English, which is kind of the lingua franca of the financial lingua franca? This is unclear, and it may very well be that MiCAR pushes, not attracts these trading venues to the EU, but pushes them outside of the EU. And therefore, what will be the efficiency of MiCAR? And if I don't have a listing, then obviously, if I'm not traded, then obviously I can't apply the market abuse rules. And now, so presupposedly, the term trading, because a law has a territorial effect, I would interpret it by saying that it should be traded in the EU, right? So we should at least have a platform, and this asset should be traded in the EU. Now, obviously, I can have market abuse happening somewhere else. But imagine now a crypto asset traded in the EU, traded also somewhere else, in the US, let's say. And market abuse happens. It doesn't matter where it happens. But in that case, this one behavior can very likely be sanctioned by two authorities, right? So are we going, here I see a parallel with competition law. Are we going to say it's different markets, so therefore I can accumulate the sanctions, or is it just one effect on the crypto market? So here there might be some issues. And also, once we say in the EU, market abuse has been, well, happened in Timbuktu, I'm going to sanction. How am I going to enforce that? So we will have enforcement issues. My second item is derivatives. So here, recital 97 is interesting because recital 97 clearly says derivatives that are financial instruments are caught by MAR, but the underlying crypto of derivatives is caught by MiCAR. So obviously we don't have a generic, if you just heard, we don't have a definition of financial instruments, we don't have a generic definition of derivatives, we have a list. So in that list, right now, there is no really reference to crypto. Article 4 of paragraph 144 of MiFID gives a definition that refers to derivatives, right? So any other security that can be cash settled and determined by reference to transferable securities, currencies, etc., 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 so cash settled derivatives. Well, in this regard, my remark is asset reference tokens are actually derivatives. I mean, their value derives from this underlying basket of currencies, securities, interest rates, other cryptos, and so on and so forth. So first I have a problem of delimitation. MiCAR does provide for a mandatory redemption right that can be settled in cash. So it totally fits this definition. So what am I going to do with my ART? Am I saying, well, we first said MiCAR only applies if anything else does not apply. So does MiFID or MAR apply to this situation? I'm not so sure. Or can we say, yes, but the asset reserve is actually, the ART is not deriving its value from the asset reserve, but the asset reserve is just stabilizing the value. Is this the difference? Can we make this difference really? And then say this is only MiCAR and the rest is MAR and MiFID? So open question. My second point on derivatives is that obviously, as I just said, derivatives, the derivative itself can be subject to MAR and MiFID, the underlying crypto to MiCAR. If I have an ART, I can also have financial instruments in the basket of the ART. So this means that if I start manipulating a financial instrument that is in the basket of an ART, don't I also automatically manipulate the ART? So here we will have a permanent problem with cumulative application of MAR and of MiCAR. How do we deal with that? Are we going to say, well, the underlying is something, the other one is something else, even though each derives the value from the other? And so I apply both sanctions. So actually I sanction the person twice. Well, it's a question. On market manipulation, I'm going to be very, very quick because I think that on market manipulation, actually, there are probably the biggest parallels with any other type of market. Most cases of market abuse are actually on crypto market, are market manipulation cases. And the strategies are exactly the same. Right? So the latest and probably the funniest is the hack of the SEC's Twitter account just one day before the licensing of the Bitcoin spot ETF. And obviously that was a classic market manipulation case, right? But there are others. So it appears that most of the time right now in practice, we have more market manipulation cases. And here I dare say that any market can be manipulated and you don't need to change strategies necessarily. Perhaps the instruments are different, but the strategies remain the same, and obviously it should be sanctioned. This is also the reasons why NTF markets should be actually caught by by one of the texts, but are they not? It's a question. There are obviously a couple of points missing under market manipulation aspects from MiCAR, for example, the definition of legitimate reason, and so on and so forth. But here, I don't know, can we say we are going to interpret it like MAR? Because a judge who knows how to apply MAR is probably not going to apply MiCAR differently. I'm not saying that we're applying MAR, but perhaps the way we're going to say the law is going to be MAR inspired. Now, let's look into insider dealing. So with regards to insider dealing, there are actually very few cases of insider dealing. The last one that has been sanctioned in the US in August 2023 is this OpenSea case of insider dealing I just mentioned. Why was it sanctioned in the US? Well, because they have the Howey definition of what is a security, and that allows them to catch fish very easily, what we can't do. So let's look first into inside information. Here, there is a difference between MAR and MiCAR because MAR targets the issuer a lot, and MiCAR targets the issuer, the offerer, or the person seeking admission to trading. Now, with regards to the offerer, it can be the issuer or it can be a third party. And the person seeking admission to trading can be the trading platform operator itself, can be the offerer, can be the issuer, or can be a third party, right? So there's more diversity into these, if we may call them, and I question it, natural insiders, because I'm not totally certain they are natural insiders. So with regards to inside information, there are two ideas. First of all, as under MAR, MiCAR mandates a lot of mandatory information on these three actors, which are the offerer, the issuer, and the person seeking admission. Now, in my view, the offerer and the person seeking admission have to be distinguished from the issuer. And what I'm asking is this obligation to provide, so the obligation to provide information is broader under MiCAR than under MAR. But are these people actually really sensitive to the effect of the value of the underlying crypto? So if you are looking into, for example, the offerer, that is not the issuer, so I'm putting the issuer aside, the offerer, a third party, or the person seeking admission to trading, right? What influence does this person actually have on the value or the price of the underlying crypto? Because they need to have a significant effect. But I mean, once they offered, they made the primary offer, what's happening afterwards, does it really relate to the offeror? Or does it really relate to the person seeking admission? I'm not talking about the trading venue itself that decides to list a crypto. And there obviously you can have insiders, as we just had it. Right? But you just, generally speaking, there is an obligation to provide information on these actors. And I don't quite see the relevance for what is happening actually underneath and how it is affecting the value of the instrument. With regards to the issuer, well, here in financial instruments, obviously, as financial instruments, bonds and shares, especially shares, are a hope for future gain. This hope for future gain depends very much on the issuer. It actually is a representation of the value of the issuer. So here the correlation is very, very close. Less so for bonds, depending whether it's variable interest indexed or not, or whether it's fixed interest, but still, so the issuer makes a lot of sense. And what is happening to the issuer makes a lot of sense. With regards to crypto assets, now, when I look into EMTs, e-money tokens, the value of an e-money token does absolutely not depend on the issuer. It depends on the underlying fiat currency it is pegged to, right? So even if there is a takeover on the issuer, is that going to affect? And you're managing it through an asset reserve, right? So how is this going to affect the information on the issuer? How is it really going to affect the e-money token, unless if there is resolution. Perhaps then there might be an effect on the value of the underlying e-money token. With regards to ARTs, asset reference tokens, here again, the value depends on the asset reserve. It doesn't depend on the issuer. So I would dare to make the same analogy. With regards to utility tokens, well, here we should probably distinguish. Utility tokens have a dual nature. They are a means of exchange for goods and services of the issuer. That's the difference with the currency token. The currency token can be exchanged against any goods and services. Obviously, a utility token can become a currency-like token at time. It's the case of the Ether, for example. So it really depends who accepts it as a means of payment. So here, with regards to this aspect of the utility token, the question is there existing utility or is there future utility? If there is future utility, obviously the issuer is relevant because he might just run off with the money. And if he does so, the utility will never exist. So here, I understand the relation, the information that needs to be given on the issuer. If the utility exists, so here the issuer becomes more irrelevant. Why? Well, because we're talking about public blockchains. It's a service or a good provided on a public blockchain that very often puts in relation, it's a sharing economy. So the issuer very often creates the ecosystem and others are proposing the good or services in this ecosystem. So in this regard, unless the utility is really a voucher or something, that the issuer is the only one that can provide the good or the service, the issuer becomes irrelevant once the utility exists and is live, right? If it is obviously on a private blockchain and the issuer is managing the private blockchain, this may be different. The assessment may be different. But the utility token is also an object of speculation because it is traded. But here, its value is really the market that decides on the value. It's not so much once it is on the market, it's really a question of offer and demand. It's not so much what the issuer does. Now, in order to respect my time and not take Matthias' time away, I'm going to be quicker on the categories of insiders. So here we really copied, more or less, we copied MAR. There is one specificity because we relate to the distributed ledger technology and similar technologies. And in one recital, they mentioned the use of smart contracts and concentration of mining pools. Obviously, very quickly, I could say, as everyone can be an issuer, why do we need all this list? But this is true also under MAR. Anyways, I'm going to jump this in order to get to my crypto insiders, because in my view, obviously, there are more natural insiders on cryptos than perhaps this category of insiders we just saw. So the first person here could be perhaps the hacker. So hacking is in itself an illicit behavior. Is there any room to say that beyond that, we have insider dealing once you hacked something? So it is already caught by criminal law. In the US, there is a pending bill to include hacking actually into the scope of insider dealing. So perhaps there is a relation, we should think about it. Smart contracts, where if the mechanism of working of a smart contract is openly accessible to anyone, can there be inside information on a smart contract? I'm not so certain, but what could happen is that the smart contract increases market tendencies, or that it can be used as a tool to manipulate markets. So here the smart contract can have an application. So it's probably more about market manipulation than insider dealing. With regards to miners, where the recital talks about mining concentration. This relates to proof of work. At some point, we had 40% of all Bitcoin miners in China because energy was cheaper. Then China forbade Bitcoin mining, and now they're spread across the globe. And obviously, for sustainability reasons, most blockchains try to go towards proof of stake. So Bitcoin is not going to change, but perhaps the younger generations of blockchains use rather proof of stake. So when we talk about proof of stake, here actually what we're doing is telling the person who has the biggest interest in the network should be the one mining, validating, right? So obviously there could be collusion, and there are a lot of other areas of the law that could be applied to these mining, well, to staking and to staking pools and so on and so forth. What I'm wondering is that imagine that a miner proposes a fork in a blockchain. Is that privileged information? Is that inside information? Probably. You don't know if the others adopt it, so it's not likely, but when does it become likely to be adopted? So when is this an inside information? When is it public? Especially miners chat on chat messages, right? That is known to the Bitcoin geeks and to the crypto community, but not to the large public. So is that inside information when the information circulates on these chats? So a question. And to finish, because I just have a couple of seconds, is what is missing under MiCAR? Well, there are a couple of obligations that do not apply to MiCAR and a couple of exemptions that do not apply to MiCAR. I tried to invent a color code, green meaning it is less burdensome for MiCAR, red meaning it could be useful for MiCAR, blue meaning probably interpreted in the light of MAR, and purple meaning not relevant for MiCAR, right? So the notifications and list of financial instruments, that does not apply to MiCAR. So on the one hand, you can say, okay, it's an obligation less for the trading venue to notify, but at the same time, supervision is actually easier when you know what is traded on a platform. So it can also go against the trading venue. The insider lists, so here again, you don't have the obligation to make them, but it would be actually good to know who you have to supervise, because then you can be sanctioned if you don't know who to supervise. So how are you going to manage your risks? Managers' transactions, there's nothing on managers' transactions under MiCAR, and I don't see why it's less relevant. If we put them into the categories of insiders, it should be there. Investment recommendation and statistics. So here, there's nothing. It could have been interesting for MiCAR, but is it going to be interpreted in the light of MAR, or is the law going to be applied as MAR is in this regard? Disclosure of dissemination or dissemination of information in the media, there's nothing under MiCAR. Here again, it happens every day, also on crypto, so why is there nothing under MiCAR? The exemptions for buyback programs and stabilization. So here, a lot of people may say, not relevant. Why? Because, well, it's not a share, so, I mean, I buy it, it's their market making, and so on and so forth. But it is a safe harbor for market manipulation. So if there are buybacks and you don't have any safe harbor, perhaps there should have been created some safe harbors that are specific to crypto. Exemption for monetary and public debt management, not relevant for MiCAR. Legitimate behavior for insider dealing. So obviously, a takeover or a merger is probably not an issue for crypto assets, but as we just saw, the issuer is less relevant. But there are also behavioral, legitimate behavior that is behavioral driven that would have been interesting. And the same is true for accepted market practices. Perhaps the authorities should have had the opportunity to outline some specific accepted market practices for crypto assets. Thank you for your attention.
Thank you very much, Iris, for a lively presentation. You probably leave us all depressed about the amount of gaps in the scope of MiCAR and about the inconsistencies of that regulation. Maybe the Commission should have waited and thought a bit more about how to regulate the topic. Thanks a lot. Now we come to the fourth speech. Matthias, the floor is yours.
Thank you very much, Rolf. And I know it's already late, so I try to make this light, and I'll try to dream a little bit about MiCAR. Right? So I'll take you on a dream that I had when I prepared this speech. I was lying awake at night, and I was thinking, like, what could I compare MiCAR to? So that's MiCAR, right? And I thought, well, I can compare it to my car. This is my car. Why? Why can I compare it to my car? Well, 3 reasons. First reason, the design is not clear. Second, you cannot rely on it working properly. And third reason, the moment it was created, it was already technologically outdated. So let's start with these. The design is not clear. Well, MiCA tries to do everything at once. It tries to promote innovative technologies, protect investors, promote market integrity, and so on and so forth, but also save monetary sovereignty. And you cannot reach all of these goals at once, right? If you want to have a 300 kilometers per hour Ferrari, you cannot be at the same time environmentally sustainable. And that, we will see, leads to conflicting rules. Also, again, remember my car, it is cobbled together from spare parts that have been taken from all over the place, from very different areas of the law, and they don't really fit together. So we have from financial law, for instance, we have taken the rule on the white paper, which is the functional equivalent of the prospectus. We have a regulation of service providers, of exchanges and trading venues, and we have market abuse rules that Iris just talked about. We have from banking law, capital requirements, qualified holdings, recovery plans, and we have rules that are clearly inspired by payment services law, such as, for instance, those that relate to the e-money tokens, and also the prohibition of interest for stable coins and the cap on usage of stable coins. We have investment fund rules, or rules that are similar to investment fund rules, like, for instance, the rules on where the reserve of assets can be invested and the right of redemption of the investors. And then finally, we even have consumer law in it, because there is a rule that says you can withdraw any acquisition of a token from any contract for the acquisition of token within 14 days, unless it's a listed token. So, doesn't work really well together. It was just a copy and paste job that was done here. Then the structure. Already the terms of Title 3, the titles of Title 3 and Title 4, asset reference tokens and e-money tokens, is not very appealing, especially if you want to sell this on a global market and you want to make this the gold standard of regulation. Only it takes a while until you understand, okay, these are basically stable coins. What they mean here is stable coins. And since we had some legacy in the e-money directive, we divide them up into asset reference tokens and e-money tokens. Okay, forgiven. But what's Title 2? Crypto assets other than asset reference tokens or e-money tokens. I mean, was there not somebody in the commission who thought, like, I can find an easier term for that, like normal tokens, ordinary tokens, or just tokens, right? It means that in some provisions, one provision, for instance, says this regulation governs assets other than asset reference tokens or e-money tokens, comma, asset reference tokens, comma, and e-money tokens. I mean, how clumsy can it get? Now, you cannot rely on it working properly. It has already been mentioned by many, including Filippo, for instance, that the borderline to traditional financial law is not clear exactly. So what is clearly inside of MiCA are payment token and utility token. And what shall be outside are investment token. But what are actually investment tokens? So these are token that qualify as financial instruments. But as Filippo rightly said, we don't really know what are financial instruments, especially when they are in the form of crypto assets. And we wait for some guidance by ESMA, but I'm not so sure that it will be very helpful or clear guidance on this. Stable coins are in it, cryptocurrencies are in it, but then NFTs are outside. But as Iris said, well, some are inside if they are part of a series, for instance. And again, we don't know exactly what that is. So already we don't know the scope very much. Then we have many interpretative problems because, as Iris said, Well, these things are taken together from different acts, and the question always arises when there is a divergence, and there is often the divergence. Remember, MiCAR is just 150 pages, and the text that it is copied from are thousands of pages. So necessarily, there will always be divergence. And the question is then, is this intentional? So shall we not apply it? Or on the contrary, shall we apply it as in the other cases? Just one example, the appropriateness test is missing in the duties when you sell or offer token. So what does it mean? Does it mean we shall ignore it or we shall apply it? And then the other issues that here is also mentioned. Then we have even blatantly contradictory rules. So for instance, stablecoins, which are really at the heart of MiCAR. On the one hand, MiCAR tries to increase the attractiveness of stablecoins by protecting investors through various provisions. For instance, that the issuer has to hold a reserve of assets, that investors can redeem their rights, and that there have to be recovery plans and redemption plans. But, and that seems like, okay, we want to promote stablecoins as a means of investment. But then it says, no, you should not grant interest, probably, because they should be used. These stablecoins shall be used only as a means of payment. Okay, then we use them as a means of payment. But then there is a hard cap in Article 23 that says, okay, but only up to a point. We accept them only if the number of transactions doesn't exceed 1 million per day and the value of these transactions is below 200 million euros per day, because otherwise they would endanger monetary sovereignty. That means the euro, the zloty, or the krona. Well, the question here is, what do we actually want? Do we want to promote stablecoins, or do we want to limit them? You cannot have it both ways. Especially, you cannot say, okay, we want them to use them, we want them to be used only as means of payment, but then say, but if they're too successful as a means of payment, then they are prohibited. It goes further. Even if we accept that we have to fight stablecoins because they could somehow be more prevalent and used more than euro or other currencies in the EU, then MiCAR is not up to the task. Imagine that Amazon would issue tomorrow a so-called Amazon coin that you can use to buy its goods, but they also have services like videos on their platforms and apps. And they wouldn't in any way refer to the value of the euro or the dollar or anything. They would just say, this is the Amazon coin. Use it. Okay? It would not be a stable coin, neither ERT nor EMT, because it doesn't purport to maintain a stable value to anything. So could you apply the hard cap that we just saw? No, because this only applies to stable coins, and that doesn't make sense. If we really want to protect monetary sovereignty, we should have covered this case as well. Finally, there are also worrying isolationist tendencies in MiCAR because only persons based in the EU can issue stablecoins and provide crypto asset services. There is no possibility for third countries to get their regime be recognized as equivalent to the EU. Nothing compares to the EU. And also, cooperation with foreign authorities, third country authorities, is very limited. So what we see here is also a kind of industrial policy. The purpose is not only to protect investors, but also to create a kind of European crypto industry. But this is a gamble. I mean, will it work out with all these heavy duties that we have? We are actually also cutting ourselves out and off from the rest of the world. And that may mean that at some point we will fall behind other parts of the world where certain things are available and here not. Now, the last point, the moment it was created, was already technologically outdated. to make that point, I need to first say that MiCAR is not technologically neutral. Despite of what it says at the beginning in the preamble, it is not, because it defines crypto assets. It's only targeting crypto assets, not digital assets or something like that, only crypto assets. And it defines them as being based on DLT or similar technology. And then it defines specifically what DLT is. It cannot be more technologically specific. Certain things are just regulated by MiCAR because they use a certain technology. Imagine a voucher for concert tickets, for instance. You could issue such a voucher in paper form without it being a financial instrument or any other instrument that is regulated. You could also store it electronically, would still not be a financial instrument, but if you distribute the voucher by the use of a blockchain, then suddenly it becomes a crypto asset and it's regulated. That's technologically specific. Now, technology may evolve, and that's why MiCAR authorizes the Commission to further specify the technical elements and also adjust the definitions to market developments, and especially to technological developments. That means that the Commission will always have to catch up with the innovation, and it will be a race between the hare and the hedgehog, and we know how this race ends, so something that you cannot win. Also, being technologically specific has a downside that some technologies are effectively outlawed by MiCAR. For instance, algorithmic stablecoins, where the stability is not created by some asset reserve, but rather by a clever software that balances supply and demand. And the business model is we don't have a reserve of assets. We do this synthetically. That is not possible in the EU anymore. Also, it will be very difficult to create stable coins that purport to maintain a stable value to illiquid assets like real estate. Why? Because MiCAR demands that the funds that are collected from the investors will be invested only in highly liquid financial instruments, and that is not compatible with illiquid funds. Of course, you could then add money to that and buy the real estate with your own money, but that is not economically viable. And now, why is it already technologically outdated? Well, it doesn't cover decentralized finance. That means all these services that are fully decentralized. And arguably, that is perhaps the area where we would have needed regulation most, because that we are really at a loss how we shall do, what we shall do with this kind. And there are already calls for reform, for instance, by Dirk Sethe and Douglas Arner and Ross Buckley in a study for the European Parliament, who have said we should cover this in the next wave of regulation. Also, staking services are not addressed, although they are highly important and raise many issues. A recent debate in Switzerland has shown that. Crypto lending is also not covered, and some have called for MiCAR 2.0 to cover that as well. So what are the takeaways? Be careful when you drive MiCAR, right? It's something, it's not super, don't expect too much, right? Don't use it, especially for terrain it's not made for. And always keep your back option financial regulation that is tried and tested in your mind. And what are the takeaways for the regulator? So next time you try to regulate a technology, don't regulate the technology, regulate the special use that is made exactly, and try to do this by extending the existing law to these new phenomena where necessary, and carefully, and only respond to new specific needs. Don't just copy and paste, but really look at what's new and what is needed here. Especially, don't respond only to the fears of politicians who may not really understand the technology but have read something about it. Ask the tech experts first before you do something, and coordinate and cooperate with your foreign counterparts. And finally, I think that's the most important point, don't think that you will create a Silicon Valley in the EU by regulation. That is not possible, right? You should think about the specific circumstances that have made these innovations possible, but that was certainly not the regulation in the US. And with that, some hints for further readings that we already have 2 papers in the EBI series, and also the mentioned paper by Dirk and his colleagues. And with that, I thank for your attention.
Thank you very much, Matthias, for your great speech. If I had known that you had such a rotten car, I would have never joined you in driving in it. So I hope you take the train back to Vienna and not that car. Any questions from the audience? Dirk? He will sell you a new car now.
Thank you. Not really a question, but maybe a quick remark. Of course, let's say it that way. When you look internationally, it's the first time that a jurisdiction aims to regulate crypto in a comprehensive legislative act. Of course, it's not really comprehensive because our financial instruments are excluded. And of course, many payments instruments are excluded, but at least it's a regulatory experiment. I think 3 things are to be kept in mind. When you're the first mover, you're often also the first loser. Yeah, that's very important. Yeah? So here is a step forward, very bullish. Interestingly, it started out as a pro-innovative act, and it ended up as a regulatory nightmare. Yeah? So that's just the point. I used in my presentation, and I can give you that slide, Matthias, for your wonderful presentation. I refer to it as a MiCA monster. Yeah? The MiCA monster. It's more than 200 pages long already in level 1. Already the legislative implementing acts, and we've just submitted a book on MiCA last Friday, and the implementing acts alone will be another 500 pages or something. So it's just a monster. It's a monster for an industry that's not really relevant. That's just the interesting aspect of it. But that's just the one thing. The other thing is maybe if you are engaging in an experiment, you should maybe be a bit more cautious. Yeah? You should just be maybe less bullish, maybe also less restrictive. And of course, the only way how they could draft 200 pages is this copy-out approach that Matthias is fully mentioned. So, but let's now go from the criticism maybe to the solution. And for me, the solution is pretty obvious. It will just take 5 to 10 years until it's a robust framework. But that is not so strange when we look at MiFID. Yeah? When we looked at MiFID 1 in 1993, everyone was just complaining, and I think 25 years later, those people who have complained have dropped out of the market, and the rest got arranged with MiFID. Yeah, that's just the way how it is, and so I think this will also happen with MiCA. But on the way, I would strongly encourage that we are a bit trying to be more flexible, open to innovation on the way, and if I may end with a remark on Iris' wonderful presentation, I'm not so concerned with the territorial scope because we know it all from MAR. Yeah? It's an effect-based application of the scope, but I'm very concerned about enforcement. Yeah? That's just a point. As long as the other securities regulators have not included tokens in their cooperation frameworks, there will not be cooperation across border. And so far, if I'm correct, not even the US has it, and it's the largest market, most relevant. That means the respective IOSCO cooperation agreements don't apply right now. So what we would need now is a kind of cooperation agreement reversal, and that will probably take another 10 years. And until that, we're probably losing business and influence, but there's nothing else but the US is doing, what the EU is doing over the last 10 years. Yeah, everyone who looks at the relevant share of the world trade, now it is getting very, very big, but we lost from 17.5 10 years ago to this year less than 14% of the world trade. In 10 years, we still believe that the world has to follow all rules. Maybe there's a bit more rational thought necessary when we draft rules. Thanks.
Filippo, microphone is coming.
I cannot resist. It's stronger than I am. Well, first of all, Matthias, I love your car. First of all, I love your car, and I love it because it's just as if as you showed it. That's why I love your car. That's why I love MiCAR, because in the end, we talk a lot about cross-sectoral harmonization, but if you think about MiCAR, it's actually cross-sectoral regulation under in a single text. So it's the first time that we really see this level of sophistication of putting everything we know together and see how it works. So it's fascinating, and it's interesting to see how it will work out in the end. Second, we are at the EBI, and we have I think MiCAR is now giving us a great occasion as academics, which is to start with comparative law very seriously in financial matters with a bottom-up approach. For instance, fungibility. What does fungibility mean? In order to answer that question, we have to open our civil codes. We have to look at our Roman law tradition and see how the concept of fungibility consolidated in the ABGB, in the German civil code, in the Italian. It's different. It's different. Because in Italy, what we mean by fungibility is quite different from what in France you mean is fungible. And it's a great occasion to study the foundations of these concepts. And MiCAR is sort of stimulating us in that direction. Also, financial instruments, again, the question is, MiCAR is, people forgot about financial instruments before MiCAR. It was an outdated topic. Nobody was really reasoning anymore after your thesis on financial instruments. But now people are going back, and they are, obviously, we need to reconsider what is a financial instrument. And in order to do that, we have to look at how the interpretation of financial instruments has been adopted in member states, applied by national courts, since the Court of Justice is silent. We have no precedent, unfortunately, and see whether we can build a common understanding, but not starting from theoretical perspective, not top-down. Because if we start with an abstract idea of what is a financial instrument, once we try to apply the solution that we worked out by working in our conceptual laboratory, once we apply it in a member state, in front of a national court, it will simply fall apart. So we have to start from the bottom. And finally, ask ourselves whether this notion is still, we were discussing this morning, is it really still valid, or do we need to move towards a more functional approach, such as the concept of security, or Vermögensanlage, or prodotto finanziario, because the definition of financial instrument is linked to elements such as negotiability, class of securities, and it made sense 30 years ago, but now we have products that are completely different, and what we might wish to do is to reconsider this, whether we need something that captures the investment component of a certain product. And it's quite interesting to read in the consultation paper by ESMA last week that ESMA seems to say that the investment component is not an essential element of the definition of financial instruments. You can agree on that or not, I don't know, but the simple fact that ESMA sets that issue on the table, in my opinion, is significant of how now MiCAR is sort of leading us to a new approach. But that new approach may work only if we are good in looking at what exists in the law of the member states in 27 countries. And at the EBI, I think that we have the academic capacity to start these kind of projects with a comparative perspective and see whether we can sort of imagine something for the future. But I love your car because conceptually it opens up so many perspectives, and whether MiCA will work or not for the industry, who knows, but I think it can work for the academics and for the way in which we look at these concepts. So thank you very much. Great presentations, and also Iris, yours, well, we don't have time, but we'll discuss about that on the, across the table. Thank you.
Thank you very much, Filippo. Any other questions? Yes, please.
Hi, I'm Despina Hadjimanoli from the legal department of the EBA. I want to say already for today, but also for my presentation tomorrow, that all I'm saying here are my thoughts. So do not necessarily represent the EBA, but I'm glad I attended your presentations, because tomorrow in the morning I'm also speaking about MiCA, but I'm taking a completely different approach to yours. Not necessarily that it is our salvation, but I'm taking a more optimistic approach. I think it is based partly on what Filippo was saying, that I think it is, I see it as an example of how the EU in general has functioned over the years, like the functional approach, not necessarily a good edifice from the beginning, but building on that. But I'll explain a bit more about that tomorrow. But for tonight, what triggered me, I mean, I have to start by saying that I come from not the securities regulations world, I'm more from the banking prudential world. So this is purely an idea of my understanding of my reading so far, based also on, and I want to clarify that I'm not an economist, so I'm saying this with some trepidation, but my understanding is that MiCA is not purporting to be technologically neutral. I have not understood this to be subjective, and the reason is because it is found already in the definition of the tokens. And the logic behind that, there is an economic logic behind that. We are not, I mean, and the scope also makes sense if one sees it from the point of view that I'm just going to explain. We are looking for a new kind of currency, let's say, to settle, so that MiCA is trying to, I mean, that's one way of seeing it, and that's how I wanted to hear your opinions on that. One way of seeing MiCA is that it tries to establish rules for ensuring that we have a new settlement currency for a new world where the real securities market, the trading, the settlement will happen automatically, will happen more efficiently. With that in mind, if the focus is on currency, I can understand why the focus is also on the DLT, because EMTs, for example, it's not their objective to promote consumer investor protection alone. It's the objective to create a currency that works for the new settlement, for the new market, but it also does not affect the financial stability. So it's a trial out. And it's a precursor, and it's linked also with a CBDC discussion that we're going to have tomorrow. From that point of view, it doesn't, all I'm trying to say is that we shouldn't be judging MiCA with the same glasses that we're looking at coming from the investment world. We are in a different setting. It's like a meta market. And with that thinking in mind, I think somebody could also explain the difference between fungibility. So fungibility is one thing, and it is more related to the currency thinking. But a different thing is negotiability, which is more for the investment. What do I mean with that? I think maybe the example will come from both of the last presentations. So in the example of Amazon that you mentioned, which is not a stable coin, it is on purpose that this is not a stable coin. It's not using a DLT. It is not meant to be a settlement. I mean, if the objective of the new world is to create a settlement that settles in real time automatically via the smart contracts, then it is obviously that it shouldn't be it shouldn't be called a stablecoin. It is not meant to be used for that meta market. I'm probably not explaining
I'm
myself
afraid we are
well.
running out of time.
Yes, thank you.
Yeah. Would you like to reply?
I don't know if I can really reply, but perhaps more generally speaking, also to what Dirk just said. So obviously there are a lot of things, and Matthias showed it quite nicely, that do not work under MiCAR. Well, the way it is written, and it's really a copy-paste, it's a puzzle with a couple of pieces missing. But I think where MiCAR is decidedly going to have some success, and we haven't talked about that, is the DASP, is the Digital Asset Service Providers. Because if I look into the French experience, France was one of the first countries regulating service providers. Optional regulation does not work, absolutely not. When we decided to include a couple of more service providers mandatorily under the registration regime, the numbers of service providers that were registered went through the roofs. And right now, from a practical point of view, what I see in the market is that bigger players start to look into registered French service providers. So there's quite some M&A going on in order to also benefit from this small grandfathering clause under MiCAR. And regulating the service providers is perhaps where MiCAR makes sense. On the stablecoin issue, decidedly the objective was to kill it. I think there is no doubt. And they probably managed. The aim was to kill Libra. So it is way too close to financial stability and to the monetary side of it. And half or a third of MiCAR is dedicated to that. And the only aim of this third of MiCAR is to kill it, is not to enable it. It's not done to work. It's done to not work, unless it is perhaps a bank and this is why I said only banks can deal with that. But we leave aside a little bit the service providers because these are the main actors and it makes sense to regulate them. It makes sense to regulate investor protection. It makes sense to regulate market integrity, even if it's imperfect. It doesn't matter. We started doing it and eventually it's going to get better. And as for analogy and not analogy, I think we're going to use a lot of analogy for the missing puzzle pieces, but more than necessary.
Thank you very much. We are running out of time. We still have another 5 minutes for the closing remarks of Christos. Thank you very much for the presentations and for your expert opinions. It was a great discussion. And thank you to the audience. And have a nice evening. No closing remarks, Christos? Yeah.